Welcome back to GBS Analytics Hub. I'm Uday Kumar Mudali. This is part 2 of our KPI Framework Series. In part 1, we covered KPI Fundamentals, the Smart O filter, and the 4-layer framework. Today, we go deep into Finance KPIs. Finance is the backbone of every GBS operations. We will cover 6 core functions: P2P, OTC, R2R, Treasury, FP&A, Intercompany, and Data. For each function, I will show you the KPIs that matter, the targets to aim for, and the business impact of getting them right or wrong. Let me start with the big picture. Finance in GBS is not one process. It is 6 distinct functions, each with its own performance imperatives. P2P, purchase to pay, covers everything from purchase request to vendor payment. O2C, or order to cash, covers customer orders to cash receipt. R2R, record to report, covers transaction recording through to financial reporting. Treasury handles cash management, liquidity, and FX risk. FP&A handles budgeting, forecasting, and business partnering. And intercompany and data performance covers intercompany transactions and master data integrity. Each of these functions needs its own set of KPIs. You cannot manage them with one generic dashboard. Let us go through them one by one. Starting with P2P, purchase to pay. This is typically the largest transactional function in any GBS. 6 KPIs to track: invoice processing accuracy, which has a target of 98% or above, owned by the AP manager, measured daily or weekly. This is your quality metric. Days payable outstanding, or DPO, target 30 to 60 days, owned by Treasury or the AP lead, measured monthly. This is your cash metric. PO compliance rate, target 95% or above, owned by procurement. This is your control metric. Invoice cycle time, target 5 days or less. This is your speed metric. Cost per invoice processed, target is $8 or less. This is your efficiency metric. And duplicate payments rate, target is 0.5% or less, and this is your risk metric. Notice the pattern. Each KPI has a number, a target, a named owner, and a frequency. That is the Smart O filter from part 1 applied in practice. Moving on, let me explain the 3 most critical P2P metrics in more detail. Invoice processing accuracy. The formula is invoice process without errors divided by total invoices times 100. Errors trigger rework, vendor disputes, and payment delays. World class is 99% or above, good is 97 to 98, and below 95 needs immediate attention. Days payable outstanding, or DSO. The formula is accounts payable divided by cost of goods sold times the number of days. Here is the business impact that gets the CFO's attention. Improving DPO by just 10 days on a $50 million AP base releases $1.4 million in cash. That is not cost saving, that is world class working capital improvement. PO compliance rate, invoices matched to PO divided by total invoices. World class is 98%. Below 85% is the risk zone. Every invoice without a PO bypasses financial controls and creates risk exposure. Let's move on now to OTC, or order to cash. This is the revenue side of the business. 6 KPIs: days sales outstanding, or DSO, target 45 days or less. Collection effectiveness index, target 85% or above. Invoice accuracy rate, target is 98%. Bad debt as a percentage of revenue, target 0.5% or less. Cash application accuracy, target 99%. And disputed invoice resolution, target 10 days or less. If P2P is above, how fast and accurately you pay your vendors, OTC is all about how fast and effectively you collect from your customers. The dynamics are different. P2P, you control the process, and OTC, you're dependent on your customers' willingness and ability to pay. That is why collection effectiveness and dispute resolution are so critical. The three critical KPIs of OTC that every finance leader must understand: DSO, days sales outstanding. The formula is accounts receivables divided by total credit sales times the number of days. DSO measures how many days on average it takes to collect payment after making a sale. Every extra day of DSO represents cash sitting uncollected. The global average is 41 days. World class target is 30 days or less. And here's a number that matters. A 10-day improvement in DSO on $100 million of revenue releases $2.7 million in cash. That is real money. Collection Effectiveness Index or CEI. This measures how effectively your AR team is collecting receivables that are actually due in the period. Unlike DSO, CEI focuses only on what was collectible, giving you a pure measure of team performance. Target is 85% or above. Cash application accuracy. The percentage of cash receipts correctly applied to the right customer and invoice for the first time. Errors cause customer disputes and incorrect balance statements. Target is 99% here. Let's move on to the next segment, the R2R or record to report. This is the integrity function. 6 KPIs, month end close days, target 5 business days, journal entry error rate, target 0.5% or less, account reconciliation completion, target 100% on time, financial restatement rate, target is nil, audit findings of high severity, target 0, intercompany reconciliation, target 100% matched. RTR is where accuracy is non-negotiable. A journal entry error can cascade through financial statements. A missed reconciliation can lead to a restatement, and a restatement destroys investor confidence. These KPIs are not about speed, they are about getting it right. Now let's look at why does the closing cycle matter so much in an R2R process. Let me walk you through the timeline. Days 1 to 3, all transactions are posted and accruals are raised. Days 3 to 5, all balance sheet accounts are reconciled and signed off. Days 5 to 7, P&L and balance sheet are delivered to the business. Beyond day 7, you are in the delay zone. Business decisions are being made on incomplete data. The world class target is 5 days. The global average is 8.5 days, and the average cost of a delayed close is $1.2 million. That cost comes from delayed decisions, overtime, error correction, and the opportunity cost of having your finance team stuck in closing activities instead of doing analysis and business partnering. If your close takes more than 5 days, it is worth investigating in automation and standardization to bring it down. Okay, now we move on to the Treasury KPIs. Cash forecast accuracy, target 95% or above. Days cash on hand, target 30 days minimum. FX hedge coverage, target 80% of exposure. Bank fee as a percentage of transaction value, target 0.1% or less. Cash pooling efficiency, target 90%. And working capital ratio, target 1.5 to 2 times. Treasury is often managed outside of GBS, but the KPIs are critical because they directly impact the company's ability to fund operations. Cash forecast accuracy is the one I focus on most. If your forecast is wrong by even 5% on a large cash base, you are either holding too much idle cash or running into liquidity issues. Both are expensive to the organization. Now let's move on to the FP&A KPIs. Budget versus actual variance, target 5% or less. Forecast accuracy, target 90% or above. Planning cycle time, target 30 days or less. Management report delivery, target 3 days after close. Self-service analytics adoption, target 70%. And business partner satisfaction score, target is 80% or above. FP&A is where finance becomes strategic. These KPIs measure not just the accuracy of your numbers, but the speed and quality of your financial intelligence. The one that is often overlooked is self service analytics adoption. If 70% of your business partners can access dashboards and answer their own questions, your FP&A team can focus on insight and strategy instead of producing the reports. Let's check in on the intercompany and data function KPIs. Intercompany match rate target 100%. Dispute resolution target is 5 days. Master data accuracy target 99%. Duplicate vendor and customer records target is 0.5% or less. Data quality score target 95 out of 100. And data change request cycle time target 2 business days. This is the function that nobody talks about until something goes wrong. A duplicate vendor record can lead to duplicate payments. A master data error can cascade through every report that uses it. Data quality is the foundation that everything else sits on. If your master data is wrong, your KPIs are wrong. Okay. So here, put together a summary of the in the form of a scorecard across all the 6 finance functions that we looked above. This is your one-page reference. You can pause the video here and screenshot the slide if you want a quick reference for your own KPI framework. Five key takeaways from this session. 1. Finance in GBS spans across 6 core functions: P2P, OTC, R2R, Treasury, FP&A, and intercompany and master data. Each needs its own KPIs. 2. P2P KPIs focus on payment accuracy, cycle time, and vendor compliance. DPO improvement directly releases working capital. 3. OTC KPIs center on DSO and collection effectiveness. Every 10-day DSO improvement on 100 million revenue equals 2.7 million cash freed. 4. RTR measures close cycle speed and financial reporting accuracy. World-class target is 5 business days to close. 5. Treasury, FP&A, and intercompany and master data KPIs address cash management, forecast quality, and data integrity, the backbone of financial confidence. So this is part 2 of the KPI Framework Series, covering all 6 finance functions. In part 3, we will move to HR and payroll KPIs, covering talent acquisition, attrition, payroll accuracy, workforce analytics, and employee satisfaction metrics. Subscribe to GBS Analytics Hub so you do not miss it. If you found this session useful, please like the video and subscribe to the page, or even drop your comment if you have any questions about implementing these KPIs in your organization. Thank you for watching the video. I will see you in part 3. Thank you.